much for tuning into Talking Point. I'm your host, Neeraj Shah. Every time I speak to Ajay Srivastava, I get a couple of nuggets of very important pieces of information. I get some fairly contrarian views. And whether or not Ajay Srivastava gets proven right or wrong is not my prerogative. The idea is what he tells me and what he tells all of us makes us think about things, and which is very, very critical at a time like this. So let's get him on the show today to talk a lot about the current landscape and how is he approaching investing. It's not been too long ago that we spoke to him, but the times are such that it's important to get him again. Ajay, great having you. Thanks for joining in.
Thank you very much for having me, sir.
Ajay, first question, and unlike, and it's not on the conflict, it's not on anything else, it's more on flows, simply because the last 10 days, I have been inundated with fairly contrarian views around what could happen to flows and thereby to equities. People being cautious is not new, but I think so for example, yesterday there was a BofA global fund manager survey which says that global fund managers are sitting at the highest point of cash since, I think, July 2020. In the same time, I read a JP Morgan report dated 9th of March, which said that get ready for the month-end rebalancing on a global front, wherein $230 or $250 billion, not a very large sum, but it will come into fray. And I also hear from local fund managers that the month of March, because of tax-saving funds and multi-cap funds, could have fairly seriously large inflows into equity funds, which might help Indian markets as well. Now, too much to decipher. What have you thought of when you think about flows and the impact that they could have in the markets, considering all that is anyways happening?
So I think it's more than the amount which is available on the sidelines. The important thing is, has the selling going to get abated? And if yes, that's the one key trigger for the market, because it's been relentless. It's got absolutely no days of green tick for the last 3 months or so on and so forth. And they have sold the most liquid part of the market, which was Indians were overinvested, which is the banking sector and the IT sector. And for correct reasons. I don't think it's the war. I don't think it's the Federal Reserve. I think they all realized that the stocks were at a valuation much, much more beyond the intrinsic value, whether it's Indian banking stock or the IT stock, and they sold heavily. So I think more than the amount which will come into investment, just the fact that if the selling can stop, because it gets lower, that should be a great positive for this Indian market, because that's a way that it's a limited supply of stock. Most of the good companies, the important thing is, are not diluting stock, which means no new equity comes to the market from all the bigger of the older companies at this point of time, which means you're playing with the same pool of funds. Some are doing buyback, like TCS does for 3 buybacks in 4 years. So the stock also is coming down eventually in the market. So I think the issue is, will its selling stop? And I think we are reaching a point where a little exhaustion can be seen in selling. We have brought the levels down to fundamentally pretty decent levels. For banking has corrected quite substantially. IT is reasonable. I would still say a little expensive, but reasonable. So even if one were to say things may go wrong in the global market, I think from a pure segment perspective, I think some of the segment of the Indian market are looking attractive from FIs. FIs were never in the Nestle's and Unilever of the world because liquidity is very poor and they're very, very expensive. So the two big sectors which got impacted, the banking and the IT, I think should see some relief now. And that relief rally is kind of percolating in the retail market, saying, let us buy in. Now, how will it play out in Indian context is a separate issue. But the fact is, I think we're looking at much more relaxed situation on sales of both IT and banking.
All through February, I heard people talk about 3 big events for the month of March for the Indian markets. One was the Fed. The war was an unthinkable thing then, but one was the Fed, one was the LIC IPO, one was the UP election. UP election outcome is something that has pleased the market, I'm sure. LIC IPO not happening anytime right now. And the Fed is now a foregone conclusion in that, unless Jerome Powell speaks something completely out of the book, a 25 basis points and a hawkish commentary is priced in. Would you believe, therefore, nasty surprises are out of the equation right now, unless, of course, something happens on the geopolitical front?
Nasty surprises to market come from exactly where you said, unexpected sources. It always happens. It's not the first time. In 2-3 decades I've seen it will always come through. But I think fundamentally the problem in Indian economy is, how will it adjust to a very high inflation rate? Now, that's the reality. That's not conjectural. That's an actual reality. The government, as a beautiful, I think the best change of policy would have been what they've done for the oil, have not passed through. Now, how will they fund it? I do not know the answer. But the fact is, at least for the time being, the consumer has got the money to spend and not pay on oil, with the new rate. So I think there is a huge shift in policy I can see happening in the government, where they're moving away from the whole concept called all focus on infrastructure. Let's not worry about consumption will happen, to say people need money today to spend, otherwise the economy is tottering. And we have seen that very clearly. No matter what they write in the budget, the fact is that the capital goods sector has actually contracted for the last 2 months. That's a IIP data. It's a public data, which is telling you two things. One, the government is not spending what it's saying it should spending. Private sector is certainly not spending. So I think the shift in policy is one positive feature for the market, at least for nowadays, that they are focusing on consumption, then not focusing on the long infrastructure story. Now that is becoming more and more evident and visible. And let's see how much pass-through of oil happens. So far, it has not happened, which is unprecedented. We thought on the day of the elections, the result, it would happen. It's not happened. It's been 5 days. It's still not happened. Unbelievable. Never happened ever. So I think, so from an Indian perspective, we need to look at risk of saying which are the companies at biggest risk of inflation. And number two is, if you are overly buoyant on the infrastructure segment companies, I think you need to pare your enthusiasm down. IIP is telling you the real story. Don't read the fine print. Sorry, you are in the fine print business, the headline business, but the headline business is not the reality. Reality is IIP saying infrastructure is contracting. Therefore, I think you would well guided to moderate your portfolio based upon reality than what's being told to you. So I think that's where Indian market is. If anything changes dramatically, it's different. But I think opening up consumer segment, not consumer staples I'm talking about, should do well in this market. So things may go bad, but Indians need to wed at the end of the day. So have faith on Indian wedding. They will bail this country out. My firm belief is that pure Indian weddings, and you may accuse the North Indians to be ostentatious, but they are going to bail this country out in the spending power in the starting August.
I mean, we actually don't do that, Ajay. We don't sensationalize in any fashion whatsoever. We don't give those headlines, which is why we have a small number of viewers and readers. But I think they like what we do, touch wood. Thank God for that. So let me ask you, actually, it's an interesting point that you make. And I would want to understand how you approach this. When crude was at 125, 130, almost everybody said that the oil price inflation, which some of the consumer-facing industries would have to bear, would be pretty steep for the margins. And the earnings cuts that come in for a lot of these companies, be it FMCG, be it paints, etc., would be very steep, and therefore get out of that. Now, my question is, if indeed consumers are spending, then these companies tend to benefit. Oil is no longer at 130, it's at 100. So it's a bit of a conundrum as to how to approach this. What is your thought when it comes to this consumer-facing pockets? August is some time away. What about the next 2 quarters?
No, I think, it's now becoming more and more clear that, it's not everybody's gained. You saw the aviation price increase, 18% audits happened just now yesterday. So it's not that the industrial segments are going to escape the big swath of it. Certainly not the ones, more than the oil. The big hit is coming from coal, because that's where the biggest hit is coming. Oil prices have not increased, so nobody has had to pay the burden. But the coal imports have really hit the bottom line, and most cement companies and power companies would show on the bottom line as to what's transpiring on the coal sector. So I think, you should look at, on my view, oil and coal together as a segment is impacting. And therefore, one can clearly see people like cement companies, on one side, infrastructure slowdown, on the other side, coal hit. Third side, power cost hit. So I think those companies would, my view, maybe wrong again, should definitely take a bigger hit, and cement therefore gets out of my investment list for some time. The way to look at it is it my investment list? No, it doesn't matter. Ambuja is the best company, but I still will not buy it because everybody's going to have to use coal at the end of the day, right? So therefore, coal kind of dependent companies, particularly cement, are in for a very rough ride. The number 2 segment you said, now with the consumer goods companies, now, you can raise the prices. But what happens to the volumes? We will see eventually. They have strengthened their bottom line, which is a good thing to do. But what's going to happen to the volumes? Let's see what Nestle does, what Unilever does. But the fact remains, and I think that's an important fact, that Indian consumer landscape was full of MNCs. And MNCs across the board have done most poorly in the most buoyant part of Indian market. That's a fact now that what was the retirement stocks of the people. Nestle le lo, bonus aayega, ye aayega. That has all been washed out. They are the worst performer segment of the market. You take consumer, you take pharma, two big segments, you take engineering, third big segment. You put all three together and you see how bad the performance is. So, for an Indian investor standpoint, when you say look at oil and look at this thing, more than oil, look at what the companies have done for you as a shareholder, because a good, hungry company will find a way to pass the cost. Sitting executives, fat salaries are not going to be your saviors. So more than oil, look at hunger in the companies, in the management, and they give chances to buy. More importantly, commodities, they don't get impacted. Cotton yarn, how is it impacted? A company like Vardhman, where we have investment, oil is important, but it'll gain by the rupee dollar depreciation. It's got a good performance, good promoters. So my view is, as an investor, so how do I handle it? I put oil in one bucket and says, which is a hungry company, which is the consumer segment growing, where we see the maximum traction and the growth, and then we go. What's the point of buying a company which is not growing at the end of the day? It can handle oil better, maybe better, but if it doesn't grow, Neeraj, what is the point of an equity investor? So my view is, forget oil, focus on growth, management, hunger, and you will get better returns. Doesn't matter. Asian Paints has seen how many oil issues, but performance has been superlative, absolutely. Maybe very, very expensive stock. But the fact is, did oil make a difference in a 5-year return on Asian Paint? The answer is no. The management is hungry for a return. So I think forget oil, look at a longer perspective and says, who's hunger? Go for it. Don't worry about oil. Oil will sort itself out. Maybe in a year's time, people will pass on. You will be get immune to it. We are all like the frogs in the boiling water. Till the temperature is low, we don't feel it.
That's true. Okay, so now 2 or 3 themes, Ajay, since you brought them up, 2 from the current conversation and 1 from the previous conversation. First, from the current conversation. I regard Ridham Desai fairly highly, and people may differ, but I like his thought process. And about a month and a half ago, he came out with a note saying, back up the truck and load up financials. In the ensuing 1 month, the call is not proven right, but almost everybody seems to be now on the same page that financials might do really well. I take on board your point that capex is not happening at the same pace that people believe. At some point of time, it will happen. But I also heard you say that valuations are a lot more comforting right now. Are you bullish on financials?
Okay. I think, we went off financials, if I recollect my past conversations, somewhere in 21. Early 21, we went off zero. For the first time in our history, went zero on financials. We still are very, very underweight on financials for different reasons altogether, right? Very underweight. Yes, there is a transient opportunity in the terms of, as I said, there is so much selling has already happened in the segment. You will see a relief rally. It is quite obvious. The nature of a beast that it will see rally. The reason we are not confident in the sector is 3 reasons. And very importantly, we have a difference with everybody. If the economy does not grow, there is no way the banking system can grow. Okay. Number 2 is, a lot of the old industry experts are still sitting in the time of decade of banking, where banking, no new license was issued. So these banks had a monopoly. They could do what they want to do, and they were making tons of money. RBI was ensuring that NIMs were at 4.5% for every bank. It didn't matter, right? No new license was issued. Now, fast forward last 24 to 36 months, 20 new banks have come in. More importantly, 140 fintechs have come into the play, all hitting the bread and butter market. What is the bread and butter market of the banks used to be? Bills of exchange drawn on large companies. So if you're a supplier to Tata Steel, I will discount it. Now, that is the money which is now moving away from the banks to fintech. Fintech are saying, we'll do it at a much cheaper cost. We'll do it faster. The credit platform is now a bidding platform. No more you can just do what is that. The paradigm has changed totally for the bank. And therefore, the larger banks are finding it more difficult. They cut down investment. And HDFC is a live example for that. He cut down investment to show larger profit. The bank, the shareholders paid the price of it. Therefore, the pie is not growing that much. The number of participants have grown dramatically in this market, banking segment, fintech sector, NBFC segment put together. Therefore, not a very big growing pie, so many new participants. How will the industry do well? I do not understand. And how will each player grow? I don't understand. Therefore, we are not, temporarily there could be a valuation gap, but in a 1 to 2 year perspective, I think a lot more competition on the way.
Okay. What about tech and both ends? Also because if I'm not wrong, Accenture numbers come out tomorrow, and if their commentary and evident on what they've said in the past 2 quarters, there's no reason to believe the commentary will suddenly change. What's your sense about what to do with IT services? And then the follow-up would be, Ajay, would you even touch the consumer techs, considering the NASDAQ too is now had a 20% drawdown, and maybe something might be around the corner?
See, for an Indian investor, Indian tech companies are perhaps the best haven to be, not from a short term, but from a long term perspective. And as I said, why? They don't dilute capital. That's the
Yeah.
best part of it. Little
Yeah.
ESOP dilution, but that's all about it, right? Number two is they give the money back to the shareholders. Buyback, dividends, whatever you call it, they do it. Number three, all Indian companies, by and large, have been responsible enough not to do some crazy acquisitions like Hewlett Packard did or Compaq, etc., and ruin the whole company down the line. They've been very sensible people. They've been going cash positive. They don't have borrowing, huge cash balances on the books. So I think what better combinations? Not any point of time you may see valuation is higher or lower. That could be true. But if you look at a 3 to 5, 7, 10-year perspective of your portfolio for yourself, these constitute the best set of companies as far as Indian market is concerned. And whether we like it or not, India will remain cost competitive vis-a-vis US for a long time. In fact, it's getting worse today. US market for wages and salaries is getting much worse today. So therefore, this is a combination which you cannot get in any industry. Good quality players, no capital dilution, money being given back to you as a shareholder. Compare that to ITC and you'll see the story. How does it look like? And companies being sensible about acquisitions. Core business is strong. They're growing in the right places. It's a perfect. If you ask me, investment opportunity. Yes, you may not get 50% return in a year, but over a 5-10 year perspective, if you've done 20% return, you've done a Warren Buffett.
That's true. Okay, in the same breath, consumer tech, the Zomato's, PB Fintechs, or no?
Dekho, 3 years
Nika.
down the line. Okay. See, I think most promoters will say it's unfair to put me in a bucket, right? They'll say I am different. I think as an investor, there is no doubt that 3 to 5 years down the line, some of these companies should be in your portfolio. Maybe 20-25% of your portfolio should be these companies. There is no doubt in my mind, because they are disruptors. They will eventually come in. Now, the question to you is, how much do you put in? Really, the answer is not that whether you should put in. The answer is yes, you should have them. Question is how much risk appetite you have, and do you think over time you can keep buying the shares at a better pricing? So the way I look at it is, keep buying them, keep holding them. You will get better chances to get in, but not having them, I don't think is a good idea.
Got it. Okay. Now, last two questions, Ajay. One of them is on a sector that you advised everybody to stay away from on this very platform about a month and a half ago. It's proven to be very correct, not least because of the market corrected, but real estate per se has not really set the stage on fire. Now, my question to you is the thesis getting even stronger as commodity prices have gone up? And if indeed India is forced to be on a interest rate rising trajectory, then real estate is clearly a very sensitive space.
The answer is that there are two ways to look at it. One is that with the opening up of the economy, going back to work, a big segment of the market of real estate companies which was not showing up any growth will start to show up, which is the commercial part of the market, right? So that segment is now coming into play. That's wholesale and that's so on and so forth. So that's a big segment coming into play at this point of time. The second is consumer. The demand is getting higher and higher, so the inventory is getting out because people are expecting cost increases to be passed on to price increases. So everything is working well for the industry at this point of time. The only problem is that shareholders will never see the money from this. Now, I'm not alluding motives, but that's the honest answer. So what we have done is our real estate investment is primarily through the REIT model, right? In fact, if you look at our portfolio, almost 30% through the last 2 years, 30%, that's a large chunk, is under investment trust and REITs. And that's done reasonably well at this point of time. And I still believe that that's the right model to do is, why don't you go to the REITs, buy the thing, they're more transparent about what they have assets in the books. Because, you can say that your company has an asset, but like Prestige sold off everything one day. and they're going to redeploy the money. What does shareholders see? Nothing. Well, we have a group in Delhi which sold off their premium product, the commercial bits to a group company, had a partnership with Singapore. Shareholders never saw the money of it. So while theoretically you see this group is doing it, but will shareholders get to see it? You are not going to get it. You're not seen it in 30 years, my friend. I don't think you'll see it for next 30 years. So REITs may be better to see some return, some fixed return, than betting on these companies.
Got it. My final question is on some of the small pockets, exporting maybe or domestic, which are all finding some flavor now. Ajay, I really want some advice from you for the sake of a lot of people who will be listening this. There are always diverse views coming that 40 साल में एक बार paper sector चलता है. Why do you want to waste time there? But the truth is that the stocks are doing well. The results might be very good. There are global factors helping that. Textiles, I mean, the currency depreciation certainly helps, and there are global factors helping that, in that the Pakistan issue and some others help the Indian companies any which ways, and they are efficient companies per se, aided by a little bit of currency depreciation. And then there are some other pockets as well. Anything within the non-limelight, smaller pockets, which you believe could be giving a good bang for the buck?
See, cotton yarn, we believe, is still underrated. It still is going to give phenomenal return. The larger of the claims will give phenomenal return. They're very undervalued stocks by and large. I think it's a good segment to be in. There is no doubt about it. Basic materials, chemicals, I think is going to be good because some of them are PSU companies. Valuation is pathetic, 3 times, 4 times P. Can you believe it? In this market, 5 times P. So it'll take its own time being a PSU, but eventually either asset will be sold or will get dividend or something will happen because all the governments want money. So I think the chemicals company, cotton yarn will be very good. One large exposure we have started to take is, but that's a very illiquid sector, so investors should be careful, is tea. Tea has been the most underperforming commodity for maybe a decade at this point of time. Now we look at tea differently to say, forget the tea. If you look at the tea garden,
the land.
The land, man. What's wrong with people, man? You're making money on a product and then you got land on top of that. What else do you want? So I think tea is one where we have started to invest now in companies. It's a difficult investment because illiquid. I'm not sure how you'll get out of it. But getting in, as we all know, is much easier. Mahabharata taught us that you getting in is easier. Getting out, you can get killed. Abhimanyu did get killed. So tea could be one of the sectors where getting in is easy, but getting out, you could get killed. But I think commodity-wise, tea companies are most undervalued, highly profitable, and therefore considered a very good segment of a commodity segment to be in. And you don't need to get off.
You believe future profitability, right? I mean, hitherto the last 2-3 years, they've kind of not been in the best of health.
Well, I can tell you a tea company which has done 4 buybacks in 5 years.
Okay.
4 buybacks in 5 years.
But would that be an exception to the rule, Ajay? Sorry, I don't track the sector as well. So you know this better, but I'm just trying to think out loud.
So you need to invest in, if there are 5 companies, you just got to pick 1 or 2 to invest, right?
Sure.
So and these are so evident what to invest in. That's when you see a company who's done 4 buybacks in 5 years and earning profits every year, it kind of says, okay, yeah, it doesn't matter if I can't exit, at least buyback mein to leta rahega.
Got it.
I'll get my return and my shareholding. So I think there are segments which are good. So these 3 or 4 segments, I think India should find good thing. A lot of restructuring is taking place and companies are splitting. You saw what happened to Forbes, from the price of 4,000 when the deal was announced, it became 6,500 on the day of the split. I do not know when Eureka Forbes list what will be the price, but that could be attractive. There are lots of schemes going on in the market. You're seeing we have a holding in that GHCL, which is splitting its 2 arms, the chemical arm and the cotton spinning yarn. Now, these are opportunities which keep coming to investors. You got to be alert. So market gives you good opportunities. You should have never complained about the market. Fall will happen, but still you'll see good cases.
Got it. Lovely as always talking to you.
Thank you very much.
Ajay Srivastava. Thank you so much, sir, and stay safe.
Thank you. Have a good day.
Thank you. And viewers, thanks for tuning in.